What are the parameters? What are we screening for? What are we looking for? So this is my velocity scan within MarketSmith. It is a price and volume based screen. So I'm looking for a price gain greater than 3%. Now, that may vary. You may find it more comfortable to be 4%, 5%. And I know there's some, other well-known traders that have a higher percentage, and that's fine. All of these, this is kind of a starting point. All of this, can be adjusted for your comfort. But for me, 3% is what I'm looking for. And more importantly, I'm looking for volume that's at least 30% above the 50-day moving average of volume. So, the higher the better. I love to see triple digit volume or more, but that 30% is going to kind of be the level that puts it on my radar. And when I combine that with a 3% or greater price move, that's what's going to populate the scan for me. And then I can go through those. I do have some minimums in here that I'm looking at for average volume. Now, this is a little bit less. I have 150K on average volume just because some of these names are very young stocks. A lot of times we're looking for those can slim names. And when that's the case, it's a much higher threshold for volume, 300, 400, 500K. When it comes to these smaller names, newer names, maybe some of them are just coming up from that, $6, $7, $8 level into $10. They don't have a lot of sponsorship behind them, not a lot of fund ownership. So in that case, I want to get them on my radar a little earlier. So that's why my minimum for average volume in this case for this screen is 150K. I have some minimums in there as well for the composite rating and the RS rating. And I have that set at 60. The reason for that is I don't want to get the real junk stocks that are coming off the bottom, that have been in downtrends for months. And then all of a sudden there's either news or some, short squeeze or a meme theme name that's all of a sudden popping. I'm not as interested in looking at those. I'm more interested in the ones that, have some history behind them and are not coming off, their ultimate lows. Ideally, I like the low float names. In this case, and for this screen, 100 million is what I'm using for the float. So, and we're going to discuss this more. Lower is not always better, and sometimes a little bit above that can be good. And we'll discuss that more when I get into the examples. But I would say 100 million, that's kind of a good area to draw the line there. In that case, at 100 million, and we're going to be looking at the volume and how it associates with that. We know that there's low supply. So then if we see that we get a price change greater than 3, 4%, and that big volume is coming in, we know that you have heavy demand. So it's that combination of the low supply with the low float and that heavy demand coming in that we're noted with the price change and the volume change. That's really the ideal situation that we're looking for and what we're trying to highlight and what we want to stand out to us. Now, another thing, and again, we'll go deeper into this, but how long does it take for that particular stock to turn over its float? So there's a big difference between a stock with, let's say, an 8 million float, and it's above average volume, and that volume coming in is 2 million. That's not bad. But a stock could have an 80 million float and turn over its volume, its float on a breakout and do 100 million. That's huge. It's flipped its float in one session. We'll talk more about that. But float on its own doesn't usually tell you the whole story. You really have to dig in a little bit, compare that to the volume, and then ask yourself, how long is it taking over days or weeks? How long is that stock taking to turn over its float? And what that tells me is the magnitude of a potential move on a breakout. If it's really turning over its float quickly, whether that's in a period of days or a week or two, I know that the potential of that stock to move quickly with velocity, it's significant, significantly more than something that maybe has 150 million float. And even though the volume increased, and that volume may be 10 million, that's only a 15th of its float. So it all has to kind of come together. And we'll get more into that, and I have some examples. Flexibility is important. Understanding, especially with what we've just been through, that market conditions change, and you may have to adjust these variables a little bit. there may be times when you run this scan and it's giving you one or two names. If that's the case, you may have to bring, either the price percentage changes down or maybe some of the parameters. Maybe it's a risk off environment. And if that's the case, you may have to raise that float up. Maybe it's the liquid leaders or the big tech names are getting more attention than the low risk, ones that have the lower float. So it's an ideal starting point from my perspective and from using it for years and years and the research I've done. But it's exactly that. It's a starting point. Don't be afraid to adjust the variables to fit both your personal preference as well as the market conditions to a risk on versus risk off environment. There's usually a catalyst. There's a reason why that price jumps and that volume jumps and it's coming in heavy. And I don't need to really dig deep into what that catalyst is, but it's good to have an idea what it is that's showing what's causing that spike in both price and volume. A lot of times it's earnings, EPS, there's a big beat, whether that's on the revenue side or the earnings side, maybe it's guidance. A lot of times there's a surprise to the analysts. We're beating their expectations. There's some event that's taking place that's catching the market off guard. We've talked in the past in detail, more specifically, about power earnings gaps and how that really affects what we see in the action and price and volume. And it's telling you a story, but EPS isn't the only, catalyst. Sometimes it can be news, introducing a new product, a new service. Maybe there's new management, new contracts, new licensing deal. There can be a different event. We see with drug makers and biotech all the times, whether it's FDA approvals, maybe it's study results come out in phase 2, phase 3, something like that comes out, and it's better than what was expected, or it's news, it's new, and because it's catching the analysts, the funds, the institutions off guard, you're going to see that. You're going to see that in the footprints of price and volume. Sometimes it's just a group move. We saw that recently in oil and gas. All of a sudden my velocity scan was nothing but oil and gas names. And when that's the case, it's pointing you to the group it's telling you that, hey, there's money flowing into this group. When day after day after day for multiple weeks, you start to see the whole group in the screen and everything steering you towards that direction. You want to pay attention when that happens. More recently, right now, we're seeing that with biotech. A lot of the biotech names, are being highlighted. On occasion, we're seeing that with solar. We're seeing that with some of the China names. So it's a rotation. And even though we had weeks and even months of where it was oil and gas, coal, it was all commodity energy based, it can change quickly. We literally went within a period of a few days from all oil and gas names to all of a sudden popping up with biotechs, multiple different types of biotechs, and not an oil and gas name to be found. And that can happen very quickly, which is why this is a screen that I run daily and share it daily, because it can change quickly. The other thing is a short squeeze. Whatever the reason may be, sometimes it's technical, maybe nothing changed fundamentally, but technically you came through an important moving average, or you took out a trend line, and you can get that short squeeze, and it can clue you in that hey, this short squeeze is coming. Now, when we discuss short squeeze, and again, when I tie this in, I want to make sure we all have an understanding. I kind of divide the short squeeze up into two parts, because you may have a short float, and the short float is the percent of the shares held short relative to the available shares of float. And above 20%, we consider that high. So you see here on this one, 21%. That's high as far as short float goes. But a high short float does not always equal a high short ratio. It's based on average volume. The short ratio is very important because that tells you the approximate number of days it's going to take for shorts to cover their positions at the average volume. So the higher the short ratio is, the longer it's going to take for them to buy back those shares. And you've got organic buyers in there too, especially as you'll see in some of the setups, as they come through some of those technical levels, you're going to have organic buyers in there along with the short covering. And that's what creates that explosive move. Now you can have a short float that's higher than 21%, and sometimes even significantly higher than 21%, but still have a short ratio that's not even 1 day. So it's important to kind of combine those to give you a big picture of exactly how much short interest is out there. And based on the average volume, what type of move can you expect, or what type of explosive move can you expect? You could have a short ratio of 40%, but if that only gives you a short ratio where it's a day or a day and a half to cover, that may not be nearly as explosive as something that has a short float of 5%, but it takes them 7 days to cover. So very, very important to kind of weigh out both of those.